Good morning. You're watching the market right here on ET now. The cues from D Street, we're holding steady. Yes, yesterday was no rip-roaring move for the markets and we were just about very quiet in a range. But yeah, in the last hour, we did see a surge coming in and we managed to lift off from the session highs. Didn't quite hold on to that 19,400 print, closing in a little sub that level. So haven't really seen any reversal in trend, but we've definitely slowed down, Nikunj, like we were talking about day before.
Yeah, I mean, that's a fair assessment that there is no reversal, but there is definitely a pause stroke sectoral rotation. You know, now you can really start dividing the market into two or three parts. One part of the market where the fatigue factor has kicked in. There are a lot of individual stocks where the sectoral churn, I think, is benefiting them. And then there is a lot of market now which is now perhaps at a zone or in that valuation bracket where you should simply be avoiding it. So we are in that phase of the market where you actually will have a very differentiated approach, and you need to have a differentiated approach. See, in the month of April and May and early June, it was a rising tide. And in a rising tide phenomenon, all ships will go higher. I'm not saying the tide is reversing, but now if you are planning to take a option, now it is very specific that what kind of ship, boat or a cruise liner you really want to board on, because I think we are in that phase of the market where everything cannot be painted with the same brush. What I like about the market is FIIs, they continue to buy. What I don't like about the market is that there are pockets of euphoria in the mid and the small cap space where you need to be slightly careful of. So if you are long, don't cut your longs. But if you're planning to commit more capital, especially in mid and small cap stocks and selectively, it's okay. But universal approach of buying the market and then just enjoying this bull market, I think that universal approach needs to be changed. I mean, April, May, June was a time when you had to just buy. Rising tide phenomenon. Now the color of the tide is going to be turbulent.
So now you're saying the differentiated approach would be to be a little bit more selective because there's a lot of euphoria in select mid and small cap stocks.
So Avanne, for example, let's look at pockets where you got re-rating, autos. That momentum will continue. You got pockets where markets are really running ahead of themselves, and that I would include. There are some defense names, there are some railway stocks, there are some stocks in the mid and the small cap stocks. They don't deserve to go higher. You cannot have a universal approach in the market. That's my limited point.
Okay, and that perhaps can be further explained by the kind of delivery data as well that we witnessed. Interesting yesterday as well, if you look at the kind of movement that you saw in select stocks within the broader market, and perhaps that graphic plate can be pulled up for you. The fact that the likes of SKF India, the kind of average difference that you saw from the last 5 days and just yesterday's trading session is evident. 4.1 times, for instance, for an SKF India. Kansai Nerolac, 2.8 times in terms of the delivery data, that is. You've got an IDFC First Bank, Aster DM, Bajaj Finserv, etc., along with the Lux Industries as well, that has seen pretty interesting delivery data. Even when it comes to the large caps as well, Nikunj, the delivery data, what exactly is that pointing toward?
See, you look at two stocks here, and the two stocks which I think are worth revisiting, one is Reliance and second is HDFC Bank. And these stocks were the late bloomers in the market rally. And last Friday and Monday, when Reliance and HDFC Bank, when they shot up, it appeared that this market, in a sense, is going to regain further momentum. But the follow-up buying between Tuesday and Wednesday in Reliance and HDFC Bank, because of technical reasons or because of sectoral rotation, has not been very strong. Similarly, one really keeps the auto stocks aside. Minus autos, the delivery-based buying in the large cap stocks is not all that exciting. So that is my limited point, that the leadership in the market is narrowing. The underperformers which were supposed to be catching up, they've not really kept that kind of momentum going, especially Reliance and HDFC Bank. Infosys, I'm not so sure if the move in Infosys matters because it's a stock which in a sense has been a backbencher. So the market is showing signs of fatigue purely based on internals. The fact that Nifty has been range bound, and Reliance and HDFC Bank have not shown any signs of elevation, even though the news and the momentum which they discovered last week and early this week was in a sense strong, but yet there has been very little follow buying.
Yeah, and I think, that pocket where you are seeing that rotation happen is now, I guess, PSU banks. That's the most, hot story right now in the market. And, some of these Q1 updates as well were indicating that there could be further headroom to these names.
So if you frankly ask me, which is one pocket where I think the margin of safety and the risk reward ratio is still okay, and you may want to stay put, or you may still want to buy for next 3 to 6 months, even beyond 3 to 6 months. So in the short term, medium term, I don't know about long term, but short term, medium term, when I say short term, medium term, 3 to 6 months and 6 months to 2 years, I think it would be PSU banks. And I'll tell you why. Look at the construct of the PSU banks. PSU banks, A, they've got a strong liability franchise. B, they're attractive. C, most of the PSU banks right now have gone through this trial by fire where the NPA problems are behind them. The institutional ownership, with the exception of SBI, is not there in any of the large PSU banks. And it's very typical of the market that when foreign institutional investors, they make a comeback, you will always see the first port of call would be private banks. But I think the difference between, let's say, an ICICI bank versus a Can bank, or the difference between, let's say, a PNB and a Kotak, I think is too large and too stark. It appeared that last 1 year, when interest rates were moving higher, they will get hit because of NPAs. That did not happen, thankfully. It also appeared that private banks, because of technology and because of better brands, they will win this liability war, but that has not happened. None of the PSU banks have lost liability franchise. So all I'm saying is that just like VATT now did indicate that you should buy into autos and you should buy into defense and you should buy into railway stocks and at some point in time into hospitals. I think for next 3 to 6 months, I will not be surprised if PSU banks as a basket, they simply outperform the private banking basket. Most of the trigger in private banks have been played out, but most of the triggers in PSU banks are yet to be captured.
I was just looking at the price to book. It's pretty comfortable, barring a few odd IOB, etc., or in SBI, of course. The smaller ones are less than 1% right now. And already on a 12-month basis, Nikunj, they are sitting on some solid returns.
But Ayesha, they're still cheap.
Yeah, that's exactly what I'm saying.
My limited point is just because the stock has gone higher does not mean that, they cannot go higher. And let's look at the 5-year chart here. Let's say for Can Bank, State Bank of India, and even PNB, of course, ran into muddy waters because of various exposures. But Can Bank, last 5 years, what's been the return? 30%. BOB, last 12-month return will look lofty, but for State Bank of India also last 5-year return, nothing if you frankly look at what the nature of the economy is. Similarly in BOB, last 5-year return 77%. So I think from a position of extremely depressed, they have recovered, so they are not bombed out, but I don't think they are reached anywhere where it could be called as a bubble or stretched valuations. What you need to avoid in this market is stretched valuations, where markets have started talking about FY27 and FY28. You want to avoid that. What you want to be with, where you can say that, okay, next 2-3 quarters, I can talk about a near-term visibility, and irrespective of what is happening in the world, and irrespective of what will happen in the election cycle, these stocks could do, or these companies will have reasonable amount of earnings, and then the valuation comfort. So very few pockets qualify that cut for me right now at this juncture, where earning visibility is decent, where macros and local factors will not impact next 2 or 3 quarters, and where valuations are attractive. That's a perfect combination for anybody to hunt if you're looking for an investment. And I think PSU banks in my book, they fall in that criteria.
Yeah, absolutely. Well, can't help but talk about the disruption which is playing out in the auto universe, and we're not talking about the stock returns. Sure enough, there's a lot of sentimental knee-jerk reaction coming in. First, after the Hero Harley launch, you had Ayesha sinking, and that was the case yesterday as well after the commentary coming in from Bajaj Auto. And then, of course, Maruti, you got to doff your hat to this one. They had the launch of their latest SUV yesterday, and Nikunj, already at 10,000 for Maruti.
Yeah, I mean, anything which has got to do with, big size, large, boys and toys, I think in India, I think it has changed completely.
Literally, that's what's playing out for the last 3 days.
42% is the SUV market is the SUV market share in the aggregate picture. So out of the number of cars, if 100 cars have been sold, about 40 are SUV. Maruti, unfortunately, has never had a very dominant market share in the SUV market. Up until now, it was dominated by Mahindra and
Sedans,
Mahindra.
yeah.
So, Maruti was a small car. They kept on innovating. They did not go the EV way. They were experimenting with sedan. They came up with Grand Vitara, but that wasn't one-off. But now I think Maruti has really rebooted their entire stable. So, they are no longer, there was a time when Maruti would say, okay, we will give you a small car with an air conditioner. We will give you a small car with a power window. We will give you a small car with automatic gears. Now Maruti is saying, okay, we will give you a big car, which is
With all that you want.
all that you want, and it will come
You
from
wouldn't have to
Maruti.
look at a Toyota.
Exactly.
We've
So
got a replacement.
that's what they're trying to
Yeah.
do. Look at the Jimny launch. I mean, that's a very unusual car which has come from a Maruti stable. That's more like you've come out and you've tried to compete with a different product line. So Maruti, I think, is renovating itself. Now, typically what happens is, and we've been speaking about it, why Maruti is outperforming. Well, when there are car launches, then a company which has the strongest car bracket, that sector and that company always tends to do well. So Mahindra and Mahindra, when everybody knew that there was XUV 500, there was Thar, there was reboot of Scorpio, which all happened in 2022, was the best performing auto stock. Similarly, look at Hero MotoCorp. When new bike comes in, the stock has gone up. Bajaj comes up with a new bike, the Triumph, that stock's gone up. And then you've got Maruti, which has come out with one launch, Jimny, another launch, more are expected. The stock is outperforming. That's typical of how market they tend to get excited about what is happening to car launches. So it's very simple. Look at the portfolio of car launches or new launches from any auto company, and then be rest assured if it's decent, then that sector will actually start outperforming. That's how typically I've seen. But yeah, Maruti for me, I think they're trying to literally not change gear, but they're trying to add another gear.
Yeah. And then, of course, you have Rajiv Bajaj making the statements that he did yesterday, that Royal Enfield is the bank and we are set to rob it.
Well, with all due respect, he also said that about the electric vehicles that, we champions, they always eat oats.
Yeah.
And frankly, it's gone the other way around.
Yeah.
So, of course, I mean, to grant it to Bajaj Auto, look, the stock is almost at 5,000. Unlike what Hero MotoCorp has done and TVS has done, I mean, he's trying to reboot himself. And unlike a lot of auto companies now, he's got a very formidable market share, which is coming from exports. So at least, he's got a differentiated company and a differentiated product model. But it's going to be a tough fight to really shake out Ayesha from that, supremacy. Just think about it, RE350 is nothing new. It's a 20-year-old platform, but it still has acceptance. Yeah. And you don't know anything about consumer. I may give consumer more, I may give consumer less, but if the consumer still wants that RE350 platform, so be it.
Yeah. Well, it's definitely shaken off the stock market moves. You've seen Ayesha actually lose quite a bit in terms of market cap over the last 2 days. And yeah, it's Bajaj Auto and Hero MotoCorp which have been the flying ones. But let me take it across to Naresh, find out whether there's going to be any action or traction in the markets, or are we going to continue to consolidate? Kunal as well joins in. Naresh, hi, good morning. Good to have you on the show as always. Another day of consolidation, or could we see another attempt at 19,400 plus?
So I would expect another day of consolidation. Yesterday, even though we had a 80-90 pointed downtick purely because of the HDFC twins, the index was still flat. So today we could see some bit of a consolidation, and we've moved up quite a bit. So after the breakout of 18,900, we've gone to 19,400 mark. So that's a 500 pointer move after the breakout. The targets are done, and now we need to get into a pause. I think the new range could be 19,200 to 19,400 for the near term, and 18,900 remains the big pivot point for a trend change. On the Bank Nifty also, we've seen some bit of momentum in terms of stocks. So if you look at ICICI Bank hit a new all-time high yesterday. So we are seeing some leadership come in. We've seen PSU banks do well, although they don't have a major weight on the index. But overall, the bias is positive, but a pause is needed because we've had a sharp move over the last few sessions. So expecting consolidation to continue and stock-specific action to be shifted more to the broader markets.
Okay, let's find out what the view is from Kunal as well when it comes to the overall market, and may have been a bit of a sideways move in yesterday's trading session. But Kunal, is your sense that the undertone is looking positive?
Well, it's still positive, but then we've reached that overbought nature. So I think 2 days back, we flagged off that the market indicators are getting into a bit of an overheated or overbought zone. The put call ratio had for the bank Nifty had touched levels of 2.0, which is last seen I think three and a half odd years back for the indices. You had the Nifty hitting the 3 sigma Bollinger Band, which again indicates that the markets are getting into a bit of an overbought territory. I think if I'm not wrong, day before yesterday we also had the data that where 82%, 83% of the stocks in the Nifty 50 as well as Nifty 500 they were trading above the 200 moving averages. So all of that factor indicates that the markets are getting into a bit of an overbought territory. So some sort of a cool off, some sort of a consolidation is necessary for the indices, and I think we've seen that happening for the last 2 days. Bank Nifty ebbing off some 450, 500 odd points in the last 2 days. Nifty also consolidating at the 90,400 mark. So I believe this could be a healthy consolidation. Maybe another 100-point odd mild correction on the downside for the Nifty is what I would anticipate. So maybe closer to 19,250 could be a good support for the index, and that's where I would probably initiate a fresh buy on the Nifty.
Okay, let's look at autos, and that's where the party is. Car launches, new highs, exciting times. Are auto stocks overbought, or this is just a beginning of a multi-year bull market in them?
They're still not overbought, Nikunj, because you look at, for example, Tata Motors, the one which did pretty well. The stock is gone nowhere in the last 2 weeks, still trading at 600 levels. You look at Hero MotoCorp, the stock has just managed to break out. Last 2 days, it's seen a price action of some 7-8% cumulative. Ayesha Motors is underperformed. Bajaj Auto has been more sideways. I think yesterday the stock made a new high. Maruti has just come back after 4-5 years of breaking past about the 10,000 levels. So it's like the trend is now in the making, or a bigger trend is now in the making. Yes, these stocks have done reasonably well in the last 3 months. Many of these stocks have picked up 30-40%. I think Mahindra and Mahindra has picked up from 1100 odd levels to now 1400 plus mark. So many of these stocks have done reasonably well, but when you look at from their previous lifetime highs, 3-year, 6-year, 10-year highs, these stocks have much more room higher on the upside. So maybe some bit of consolidation which could be there for this sector as well, but I believe that the longer term trend in the structure still remains intact on the upside.
Nuresh, split the auto space into two parts: overbought and still ready to go.
So I would say overbought and still ready to go. Hero MotoCorp comes into it, Bajaj Auto comes into it, and say overbought which could pause would be TVS Motors. So that could be a stock which could pause going forward. And Maruti is a fresh breakout, so it's a 5-year breakout today. So that's a stock which has just started off. So that's the bet. Overall auto space, one by one we've seen breakouts happen. We saw Tata Motors first, then we saw recently Hero MotoCorp, Bajaj Auto. Bajaj Auto did a buyback, the stock did nothing for a period of time, and then got into a move about 3,400, 3,600, and has gone up to 4,900. So overall, the trends are positive. Auto ancillary as a space is also doing well. So auto and auto-related products all look interesting.
That's autos, but let's find out the top recommendations from our charters before we move forward. And given the fact, Kunal, that you've got the mid and the small caps continuing to rally to new highs, I'm sure there's a lot of opportunity and options there as well.
Well, yeah, many mid-cap names are showing signs of fresh breakouts. Century Textile is one of the stock which looks attractive. The stock gave a breakout about 900, 920 mark yesterday. Excellent volumes over the last 2 days for Century Textile. So would suggest this as a buy. Targets to be kept at 966, stop loss at 908. And BHEL has been one of the recommendations which I've been flagging off over the last 1 week from 85 levels to 90. And yesterday the stock clocked 93 plus mark. So I'm expecting this stock to hit back a level of 100 plus over the very near term. So the targets remain the same. I'm upping the stop loss from early levels of 85 to now 89. Traders could look at a fresh buy.
Okay, BHEL and Century Textiles, that's what Kunal is recommending. Nuresh, but you're sticking with the true blue large caps.
Yeah, so sticking with large caps because some of these names have made fresh new breakouts into all-time highs, 52-week highs, and expecting Nifty to consolidate. So being a little conservative here. So first is a buy on ICICI Bank. 960 was the high. That was a resistance for the last almost couple of months. We've consolidated in a tight range, broke below 930, did not see any follow-up selling, and now we are crossing about 960 levels. So that's a nice cup and handle formation on the short term. Sustaining about 960 gives us a quick target price of 1050. Given the momentum, keeping a strict stop loss at 940. Second is a buy on Hindustan Unilever. The stock has given a fresh breakout about 2700 mark, which was the shorter term breakout, as well as 2740 was a resistance for the last 8 to 9 months. And if we look at it, the stock has been an underperformer in the whole FMCG pack. For example, today HUL stands at just 10 to 15% away from a market cap where ITC has reached. So a huge catch up. HUL had made a top around 2500, 2600 back in April to May 2020 after the COVID correction. And today also the stock was at 2700. So almost 3 years with hardly any return. And now that could be a big catch up going forward over the next few months. And a 8 to 9 month high, the last all-time high, which has been made last in 2021, is around that 2850 mark, expecting that to be crossed as well. A target price of 3000 in the short term, a stop loss now revised to 2690.
Right. Okay, let's bring on board then Ashwin Patil and talk about what's really been the hot space of late, and that's clearly autos, isn't it? Ashwin, hi, good morning. Great to have you on the show. Ashwin, let's start off firstly talking about Maruti. Its first entry into the hot MPV segment. You think Invicto could move the needle for Maruti further from here?
See, well, Maruti has already, touched close to about 10,000 rupees, and we already had a buy on Maruti considering these launches like Fronx, which was launched a couple of months ago, then the Jimny, and this MPV now. So, I am positive on Maruti, but like valuations are looking a bit rich at this point in time. Most of the, I won't say that everything is factored in, but some of the positives are definitely factored in at this point in time. So it is really very difficult to actually, the entire auto space has run up like hell over the last few days, and therefore, like, it's really very difficult to give a buy on any particular stock at this point in time within that space. But yes, Maruti looks good to us. But on the FY25 positives are also, I think, factored in at this point in time. So, giving a buy at this point in time really is really very tough from our side.
Hi, morning. There's also, of course, that Bajaj Triumph launch. And while it does look promising, do you think that there is that worry of competitive intensity increasing?
Definitely. I mean, that space is ruled by Ayesha for years. With its RE and different, models within RE brand, like the Himalaya, the Hunter, etc., the Bullet, which was there earlier. And, there was no, competition in that space. It was like hands down victory for RE. But now, this space is getting hotter and hotter day by day because, we have seen Bajaj Triumph launch, and a couple of days earlier we saw Harley Davidson and Hero, that launch we have seen. And also TVS with their BMW partnership, they are also, on the prowl. So definitely that the incumbents like RE are getting challenged by the challengers like Bajaj, Hero, TVS, everybody. And definitely there will be a price war later on once all these are having their foothold very strongly in this space. So I think market share will be challenged for Eicher Motors or RE, I would say. And that space is definitely one space where the premium segment, which was not really looked at earlier, but now that space is definitely
Right.
the customers are going out for that.
Ashwin, let's look at, okay, it's bad news for Eicher, but is this really good news for Bajaj and Hero MotoCorp? Because even if they get it right, for Bajaj Auto, export is the dominant engine, and the premium bike, what they would sell, it will not change their profitability even if they get it right by 5% plus. Similarly for Hero MotoCorp, okay, it's great, it's a Harley bike, the cheapest Harley Indian roads, cheapest Harley bike, I beg your pardon, for Indian roads. But will it really move the needle for Hero MotoCorp?
See, definitely time will, tell us about that. But Bajaj, as you said, pointed correctly, it's more of their focus is now to get back their exports, equation right, because exports has been lagging over last 1 year. So their main focus is that. Also for Hero, the mass segment and the executive segment are their bread and butter. But this space is definitely one, everybody is, looking at. Some sort of profitability improvement also can come from there, though, it may be not that big on a bigger scale, but some sort of profitability improvement and catching that market is really very important, because premiumization is the theme right now. And, the big players like Yamaha and RE, and, those players are already in that space and they are doing good profits out of that. So, that space is definitely attracting other players as well. So I think, though not very, on a bigger scale on the profitability front, but surely, in the initial years at least, there'll be, some sort of challenge for the existing players. But later on, I think Bajaj and Hero are definitely, looking at that spot from a profitability point of view as well in the, after like 2 to 3 years down the line.
All right, Ashwin, appreciate your time. Thanks very much for joining in and giving us your take on the auto space. Meantime, let's put the spotlight on the two heavyweights that have been in focus of late. ITC been gaining traction, and it's interesting, Nikunj, comparing the 10-year CAGR of both of these counters. Bajaj Finance well ahead at about 49% and ITC at about 7.69%.
Yeah, that's the interesting part, right? ITC's made a comeback, but frankly, if you look at the CAGR return of ITC versus Bajaj Finance, I guess, the CAGR return in ITC is actually 10%. Look, it'll be unfair for me to compare ITC and Bajaj Finance because ITC is a 100-year-old plus company. Bajaj Finance, the decade gone by was the golden decade for them. Now, why I want our viewers to just, be with us is that this CAGR return of 49% also includes the drops. And that is what you need to really understand, that if you're holding a stock through thick and thin, through ups and downs, through cyclicality of markets, through the macro sell-offs of the world, through extreme crisis of panic like COVID and what happened in 2020. But as long as the business is growing and they've got a moat around them, they've got a management which can see through the ups and the downs and the twists and the turns, wealth creation can truly surprise you and truly delight you. So let's look at the data, that how many times in the last 10 years Bajaj Finance has corrected. And in the COVID crisis, there you go. In last 10 years, the range of correction in Bajaj Finance, 20 to 30% has happened 3 times, 30 to 40% has happened 4 times, and 50% correction has happened once. And yet, the stock has given a CAGR return of 49%. All you have to do is just stay calm. When you're holding on to a great stock, and when the business is growing, in the near term, it could be macro, it could be valuation, it could be compulsions of a fund manager, it could be compulsions of a PE investor, which may have an impact on the stock. But if you really sit tight and just forget about what is happening in the world, as long as the business is growing, then go back to that initial graphic. Despite a 50% cut once, 40% cut 4 times, the stock has given a CAGR return of 49%. It's only when you look at the data and you say, oh my God, 50% correction and still CAGR return of 49%. What is CAGR return of 49%? There is a simple law which we use in maths, which is rule of 72. We can do it on air right now. Divide 72 with the rate of return, which is in case of Bajaj Finance, 72 divided by 50. Let's round it off. Which means in last 10 years, every 1.5 year, less than 2 years, the stock has doubled. So,
the numbers speak as in the pudding.
Power of patience, power of compounding.
Discipline.
I mean, just power of patience. Buy and hold. Buy and hold.
Although for HDFC Bank, that got a little bit challenged. Yesterday, they came out with their first quarterly update of the merged entity. And, the standalone business, sequentially, loan growth is at a 26-quarter low. So those numbers really disappointed. And I think that one stock alone weighed quite heavy on the index as well.
See, Ayesha, again, for HDFC Bank, what we were discussing, the triggers have been played out.
Yeah.
The stock, in a sense, was down because markets were nervous about will the merger go through or will the merger not go through. Not in terms of not in terms of the possibility of a merger not going through, but in terms of a timeline. Markets were also waiting for this entire fine print in terms of what will happen to weightage, what will be the date. I think those factors were at play. So the stock had seen what, a 200 rupee run up when the news came out, ever since at the press conference where Mr. Parekh said that the merger will be applicable from first week of July and the last day would be 13th. After that, the run up has been about 150 to 200 rupees, right? So, it needed a reason to correct, and the reason came as far as the quarterly update is concerned. The tricky part now, Kunal, that's my interpretation, please jump in. What happens in the FNO series now? Because instead of HDFC Limited and HDFC Bank, once in middle of the series, there would be only one. So there would be an adjustment which will happen because of that FNO.
Yeah, there would be an adjustment, and it would not just impact HDFC and HDFC Bank, it would impact most of the constituents of Nifty 50, because there is a balance which has to happen. So, for example, if Reliance becomes the the second highest weighted stock in that comparison, then the flows would be adjusted, the position size would be adjusted into that stock as compared to the other names. And even from the banking play, the money shifts towards the other private sector banking stocks whenever such kind of adjustments have to happen. So I think it's not just about HDFC or HDFC Bank, but this is going to have a shift or a balance which the markets have to establish for the rest of the series as well.
Okay, on that note, let's take a very quick break. The GIFT Nifty indicating just a mildly soft start for us this morning.
Welcome back, still tuned into the market. Let's connect with our team of research analysts to find out all the stocks that are buzzing and that will be in news today. Let's start off with Marico and Adani Wilmar from FMCG on the back of their Q1 updates. How exactly have they performed? Let's take it across to Vinny to find out. Vinny?
And starting with Marico, when you look at it, the consolidated revenue, let's talk about that. That's seeing a decline in the low single digits. What they're highlighting is that India business saw a low single digit volume growth as well, while international business remained quite stable in terms of the growth over there. Now, in terms of the urban demand, that was stable, but the rural demand, that has remained unchanged for them. So that means that slowdown and nothing exciting that has happened in terms of a recovery for the rural demand is what the indication we could understand. Now, domestic business was mainly affected by the significant trade destocking that the company saw in Saffola edible oil, and what the company is expecting is that a pickup could maybe be seen in Q2 of FY24 given the sustained healthy trends that they've seen in terms of offtakes as well as market share and penetration in key franchisees of the companies. Other than that, when you look at the margins, gross margins are expected to expand materially during the quarter, and the expansion in operating margins is also expected to drive the double-digit growth in the bottom line of the company. Moving on to Adani Wilmar now, in terms of the company, they're expecting a double-digit volume growth of 25%. The sales value is seeing a decline though, because mainly this is reflective of the sharp decline that we've seen in the edible oil prices. That impacts the profitability of the company as well. It impacted the profitability of the company in FY23 and could impact the company's profitability in Q1 FY24. The same trend is continuing in Q1 FY24 is what the company has highlighted. Food and FMCG business, strong growth of 30%, while urban rural areas have also witnessed strong demand. So urban and rural has seen strong demand for Adani Wilmar. In terms of oil and food, that has recorded a 50% YOY volume growth. Industrials, the volume growth has been at 20% and revenue decline of 15%. In terms of the value, mainly due to the correction in the prices of some of the commodities over there, that is the castor products as well as oil products, which have seen an impact in terms of the revenue growth of the company. So yes, all in all, seems like an okay Q1 update coming in from both the companies.
Yeah, pretty soft when it comes to both of the companies. Marico's revenues declining to low single digits, and you've also got Adani Wilmar, which has spoken about how their overall volume growth has been around 50% for oil and food. Let's move right on then, and investors have recently been preferring pure play refiners over the OMC stocks. But why are the trends working in favor of the likes of Chennai Petro or MRPL, for instance, which have been a buzz? Let's get in Somit, who joins in with the top 5 reasons. Somit, why is it?
Well, as you can see in the data or the share price move over the last couple of months or the last 3 months, pure play refiners like Chennai Petro and MRPL have been preferred by investors a lot more compared to other oil marketing companies like Indian Oil Corporation BPCL and HPCL. Now, the reasons behind this is firstly, they have next to negligible marketing exposure. Now, the general market perception at this moment is that though marketing business has been good enough for the oil marketing companies going forward, that may not be the case because given the fact that election period is starting and crude prices are lower, this market is expecting fuel prices to fall, which would in a short lead to lower margins going forward. The second fact is that in oil marketing companies like Indian Oil Corporation, BPCL and HPCL, the government is looking to infuse funds via equity. Now, because of this, there would be EPS dilution and hence some correction we have seen of late in this oil marketing companies. When it comes to the refining environment, it has been pretty much conducive and stable, and with no windfall tax, this pure play refiners have also been able to export their product. Now, though if you see the gross refining margins are lower than what it used to be earlier, but given the fact that they are importing cheaper Russian crude, their gross refining margins are also getting a boost because of that front also. Now, of late in the past few quarters, we have seen some consistent earnings performance coming in from this pure play refiners. Also, the cash flow has been stable and the street has also started to reward this consistency in the earnings of the pure play refiners. And lastly, because of stable cash flows, the pure play refiners like MRPL and Chennai Petro were the only ones that have seen a reduction in their debt front. In fact, all the other oil marketing companies have seen a growth in their debt, and this is also one of the reasons why we are seeing such kind of an up move in the pure play refiners. In fact, Chennai Petro is largely debt free. The debt on its book is related to only working capital. However, given the fact that it's a commodity business, there are always a risk involved. Also pose the sharp run up that we have seen. The consensus view also suggests a downside. Now, the highest target price on the street is from Anand Rathi. For MRPL, it stands at around 79 rupees, and for Chennai Petro, it stands at around 448 rupees.
Thanks very much, Samit, for highlighting those that data point. Let's connect with Sandeep Sabharwal as well, who joins in on the show. And Sandeep, let's get in your thoughts first up on those PSU banks, because we were talking about how now the risk reward is looking quite favorable. The margin of safety is good for PSU banks. Do you think that that catch-up play to some of the private banks now is going to play out?
The PSU banks typically we've seen join the party at the end of a rally. So that's not to say that we are reaching the end of the rally currently, but then the possibility that there could be some rally in those banks is highly likely because the other financials are rallied. Like in terms of banks, private sector banks, majority it's been led by HDFC Bank. Other banks have still lagged behind. So my guess is that some of the other private sector banks actually could also participate. The key risk in PSU banks remains the squeeze in margins, which could start from this quarter as they lose CASA deposits to private sector banks. So I think that's the risk which investors need to be aware of.
Right. Sandeep, since we are on the subject of banks, I want to pick up on HDFC Bank. The fact that their standalone business sequentially, the loan growth is at a 26-quarter low. The merged business loans are an uptick of about just 0.6% on a sequential basis, lower than what the market was anticipating. You think much of the rally now with HDFC Bank is behind us?
Yeah, in the short term, it's most likely because one, HDFC Bank has rallied much sharper than most of the other private sector banks. Secondly, they are focusing on the integration right now, and as such, but because it was the same group, so integration might happen faster, but then the risk related to margin squeeze due to CRR, SLR requirements, as well as with the combination of the lower growth and fall in CASA on a standalone basis also is a risk to earnings in the short term. So I think post-merger, a few quarters were always likely to be tough in terms of profitability, and that could play out. So the initial rally as the merger got confirmed has played out now. So from here on, I would agree with your assessment that we could see HDFC Bank actually underperform the rest of the banking sector for some time.
Okay, fair enough. Let's move right on then and get in your take as well on some of these FMCG companies, because Sandeep, the kind of Q1 updates that have come in have pointed out that to a pretty soft when it comes to the likes of an Adani, Wilmar, as well as Marico. What is your reading, and do you believe that this sort of low single-digit growth for the India volumes is likely to continue?
So I think this quarter was likely to be soft, but the advantage from the FMCG pack overall is that raw material prices have come down significantly. So I think the margins could have bottomed out for a majority of FMCG companies. These two companies, Marico as well as Adani Wilmar, are highly dominated by the performance of edible oils or oils. And to that extent, they suffer more because the edible oil prices have come down sharply. For other companies which are more branded FMCG categories, there actually the fall in oil prices will actually aid their profitability rather than hit it. So I wouldn't read too much into the performance of these two companies as a flow through to other FMCG companies.
Sandeep, good to have you back. How are things? Hope all's well.
Yeah, so far, so good. Yeah.
Yeah. How's your dad? Hope he's feeling better.
Yeah, still in hospital, but recovering. So hopefully he should go.
So wish him a speedy recovery. So nice to have you back. The auto space is going through a bull run like never before. I look at the monthly dispatch numbers for auto companies, they are okay. But if I look at the stock prices, whether it is the stock price of Maruti or Tata Motors, even for that matter, Bajaj Auto, TVS last year, it's wow. So for a sector which is growing selectively, why are stock markets going through this mega bull run?
So if you look at it, Nikunj, many of the auto stocks did not participate at all. If you leave aside TVS or Mahindra and Mahindra, which were the initial performers, the rest of the stocks actually did not perform. And in fact, Maruti has not performed. So I'm not wrong. It's reached this level after a long time. So incremental, there were improvements in auto company performances, but then there were not significant improvements. Now there's an expectation, although the volume growth might be moderate for a company like Maruti, but because they are moving up the value chain, in terms of value, the growth will be better and margins will improve. And the markets always tend to be forward-looking. So I think the fact that there is a belief that interest rates have peaked out, and as we move to the festival season, we could see volumes revive. And the monsoon performance till now also has been pretty okay relative to the huge negativity that got built up initially. So I think there are several factors contributing to that, along with the fact that raw material input prices have remained subdued. There was an initial rally due to China reopening, but that also has now subsided. So steel prices, most of the input prices have again come down. So there are several factors contributing to this, along with the fact that auto stocks are still pretty under-owned by most institutional investors.
Okay, let's listen into some top fundamental stock ideas then. Hear it out from Nishchal Maheshwari and Sanjeev Bhasin.
So we continue to like the large cap names basically in pharma. Obviously, I think Sun, Dr. Reddy's, they have been doing a very good job out there. No doubt the stocks are not cheap, but I think the outlook on them is much more steady, much more stronger, with a very, very strong strategy out there. So we continue to like the large cap pharma. I think Oro has done well, basically coming off from the bottom, and they are getting their act right. So I think that's another stock, basically a bit of an outlier, but looks interesting at these prices. So that is our top picks out there. Sun and Dr. Reddy's, followed by Oro.
Been bullish on from Persistent and Coforge at almost 3,500 was Persistent and 3,200 was Coforge. They have stellarly outperformed. Mid-cap IT is here to stay. And you know, all the conundrum of the Infosys and the worlds, All that bottomed out when JP Morgan came out with a downgrade. I think that was the bottom. They come out with upgrades in January 22 and they came out with downgrades closer to, I think, 3 months back. Since then, IT and Nasdaq has been the outperformer. How can you neglect Apple hitting $3 trillion? And I think that the Nasdaq market is going to go back to its old highs. In the mid-cap space, both Coforge and Persistent are going to be outperformers. I will bet more on Coforge now, given the pedigree of the management, given the stake which they are raising, and given the space in BFSI where they are seeing extremely good traction on the order flow.
So Sandeep, I'm assuming that while you were traveling, you were still connected and you must be buying and selling stocks. What did you buy last?
I've just been watching.
No, I don't believe it. I don't believe it. Are you saying that in last 10 days, 15 days, when you holiday, you didn't buy, you didn't sell anything? Or you didn't track the markets? Come on.
It's nothing actually. No, I'm telling you frankly, because this rally was expected, and it's playing out. So I think what we held on is doing well.
So let's understand some of the stocks which we've discussed where you've been an advocatory of them and those stocks have done well for you. I distinctly remember in January, February, when we started talking about outlook for the year, your view was buy Tata Motors. Operating leverage would kick in, financial leverage would kick in, and voila, the stock's done something extraordinary this year. Is Tata Motors or Tata Motor DVS still a hold?
Yeah, I think it's still a hold because of the fact that there were people who believed that Tata Motors will perform for several years. It did not perform, and people got disillusioned. And I think around end of next year, early this year, many of the people exited, investors exited, or did not focus on it. And the performance improvement has started subsequently. And I believe that it will flow through over the next 2-3 years. When key changes in fundamentals or performances happen, they don't end in 1 or 2 quarters. So I think that's the most important thing we need to realize. So once we have picked up some stock at good valuation, then bottom of the cycle, then we need to wait for 1 or 2 years for it to play out. The initial moves are always fast because people don't own it. So initially you make money faster, but then it becomes steadier. So I would still think that it's at least 1 to 2 year more play, if not more. So we keep on evaluating continuously based on valuations and performance. But I would still think that there's a long way to go.
Okay. The second one, Sandeep, which you've been talking a lot in terms of an idea, has been Indian hotels. But now if one looks at FY24 and FY25 estimates, it is trading at 30 and 40 times. Is this as good as it gets for Indian hotels also?
Indian hotels is tougher because of the fact that it's performing very well and the fact that, like you said, the valuations are no longer cheaper. So now we need delivery from the company in terms of strong performance for the stock to keep on doing very well. And it's a reasonably owned stock now. Many of the mid-cap mutual fund schemes, if we monitor them, they are holding Indian hotels in the top 10, etc. So it's not under-owned. So from here, returns will be steady. So we cannot expect that the stock which moved up 4 times since the lockdown over 2-3 years will continue to move up like that. The outlook for hotels still continues to be positive. You monitor how domestic tourism is there, you monitor the airport flows, you monitor foreign tourism, tourist inflows into India. I think it's huge. And I would think that a company like Indian Hotels, with the clear management strategy that it has, will be a big beneficiary with the Taj brand, etc. And Indian 5 stars are still very, very cheap in terms of pricing relative to any of the European or US or even some of the Southeast Asian hotel chains with much better facilities and services. So as India becomes mainstream, I would still think that premium hotels in India should continue to do well over the next few years. How much it is? I would still think we could make double-digit returns out of Indian hotels over the next 2-3 years, but the pace of it will depend on how the company actually performs.
Tata Power, that's going to be the one key stock to look out for. Remember, they received a very sizable order of 1,744 crore rupees to implement the smart metering project in the Chhattisgarh state. So this is going to be one key stock to look out for. And quite surprisingly, this year it hasn't been much of a performer. It's less than a 7% gain that the stock has seen. So let's see if all these right noises come into place. You could see a decent move coming in from this particular stock as well. Just monitoring some of the other key movers from trade yesterday, while HDFC Bank surely disappointed and all the gains were within the auto pack, not quite Ayesha, but of course Hero MotoCorp and Bajaj Auto, which held out yesterday. But you also had Motherson, for instance, that held out very smartly. Some great moves coming in for a Divi's, for a Colgate, and then BHEL was also the other big mover yesterday, held out by about 7% or so. Kunal, let's address some of these breakout names, a BHEL, Colgate, Divi's. Any trading opportunity here?
Yes. So DHL was one of the recommendations. It's done reasonably well, but I believe that the major part of the rally is not yet happened for BHL. The stock should be able to surpass the levels of 100 this time around. It's had multiple attempts towards 85, 88 mark. It's failed to cross over those levels convincingly, and I think this time around the stock has managed to finally surpass those resistances. So I believe that at least a 20% up move from the previous highs of 85, 88 should be what we can anticipate. So that should take the stock back about that 100 plus mark at least over the near term. Even DV Slab I think is done exceptionally well. So from the pharma pack, this has been one stock which has recovered very smartly in the last 4-5 months. I think in the month of February, if I'm not wrong, the stock had formed a low at 2,800, 850 odd mark, and from there on, you look at the patterns on a weekly basis, it's formed consistent pattern of higher highs and higher lows. In fact, even the last 2-3 weeks, when the stock was consolidating at the 3,500 mark, even in the consolidation, it formed a higher low pattern. So that also indicates that the demand of the stock is rising up higher, the supports are moving up higher, and the stock is providing those breakouts every now and then. Again, a very formidable chart for DV Slab. So should be looked at it as a breakout candidate, and would expect this trend to continue.
Sandeep, where will that turn for the market come from, where you need to start becoming outward looking? Pharma, IT. Right now the market is inward looking, which is auto, FMCG, capital goods, defense, railways. These are inward looking businesses. Pharma is external business. IT is external business, because that's how rotation moves. I mean, sometimes it's internal, sometimes it's external.
But pharma has not done badly. If you look at the performance of some of the stocks, like Sun Pharma, almost at a 52-week high. Dr. Reddy is trading at, I think, at 52-week highs. So I think it's been disparate in terms of performance. So the revival has happened from the bottom from many of even the mid-cap pharma companies. Now, for them to sustainably perform, they will need some pricing power, and there are news flow now coming through that some sort of pricing power is coming back in the overseas market, especially the US, in terms of generic products, especially the specialty side. And that's why we also see some companies like Lupin, which perform. So Lupin is a contrarian bet which we took some time back. It did not perform for a long time, but it's done well. So I would think that there could be more upside there. IT is a tougher one because of the fact that the slowdown should still persist. I think the slowdown should still extenuate rather than decrease. So I think that's the risk in IT, and IT is so overowned that, and psychology of investors also is that they want to buy IT stocks at all times. So the maximum queries I get is, when do we buy Infosys, TCS, etc. So that is the risk for IT companies. So I'm not buying IT companies. There's a risk that there could be some turnaround and the stocks could start suddenly performing very fast. But I think we live with that risk when we do active investing.
Well, the other pocket which has been active of late has been the entire OMC pack. And look at JP Morgan and what they have to say about OMCs. For IOC, they're maintaining an overweight. They've hiked the target price to now 110 from the earlier 100. For BPCL, a neutral stance, target price up to 400 from the earlier 350. HPCL, an overweight again, target price now up to 330. And they're saying that OMCs are in a sweet spot. The discounted barrels are now adding to their GRMs, and the retail gross marketing margins are at a record highs, and therefore they are increasing their estimates across the OMC pack. Sandeep, you've though not been a fan of OMCs ever, have you?
No, it's foolish to buy these stocks because you never know what the government is going to do tomorrow. State elections are coming in a few months. Suddenly there'll be fuel price cuts. And so these companies have no control over their profitability. So how do you buy such companies? I just can't understand how people just tend to give such recommendations and become euphoric at the peak of a possible cycle. I think it's imminent that as these companies recover their previous losses, we'll start seeing price cuts. And along with price cuts, if somehow, for some reason, crude oil also suddenly starts rallying, they are not going to increase prices then. So I think it's a fool's game buying into these stocks.
There you have it. That's the view coming in on some of those movers in trade. But let's get you the stocks on the editor's radar then. And today we're putting the spotlight on the hospitality space. We'll also be talking about FMCG. Let's begin then with Indian hotels and just the trend in general, because monsoon season as well is looking pretty promising for a lot of these hotels, and Q2 is generally weak.
So I'm picking up what we've got from Oyo Rooms in terms of forward guidance. They've said that the holiday season or the summer season has not been bad for them. But will that really apply well for the entire hotel industry per se? This is a tricky time now for the hotel industry. One side there's this excitement and belief that the growth in some of the hotel stocks would only be linear and things will only migrate higher. But where we are getting a sense of a bit of a churn and a bit of a slowdown is that the business travel purely in terms of affordability could really be in challenge. The quarter gone by, I think, would be an interesting quarter for some of the hotel stocks, largely because of the valuations they are at. You know, Indian Hotel now is at 380, touched 400 rupees. Lemon Tree in last 1 year is up 40-45%. The forward P multiple for Indian Hotel is 25 times, Lemon Tree 18 times, Chalet Hotel 18 times. These are not very cheap P multiples.
Yeah. And so they've already run up.
So you have to really understand that while the big picture from in 2 to 3 year time frame is great for hotel industry, is going to be more demand and more demand and more demand and very little supply. More demand, little supply. But our market's pricing that in at these valuations. And a little bit of miss here and there, these stocks could actually get into time-wise and price-wise correction. So while Oyo Room is indicating that things are looking okay, but I think from a market standpoint, the quarter gone by I think would be an interesting one. So let's see how this entire space moves. I get a sense that maybe the linear move in some of the hotel stocks is clearly behind us.
Okay, that's the view coming in on hospitality. Let's move on then and talk about Marico and Godrej Consumer. A lot of these companies have come out as well with their Q1 updates, and the underlying factor that they're alluding to is that it has been single-digit growth.
Yeah, this company is in a spot of bother. And I think it is getting evident. I mean, the idea that, they are a very focused and a very concentrated company, both in terms of oats and oil and in terms of the Parachute brand. But the volume growth, I think, is now on the lower end.
And rural
isn't picking up. But the Marico commentary versus the Godrej commentary, I think there seems to be in contrast here. So I think we are headed towards a quarter for the FMCG companies where not everything will do well, but not everything will do poorly. The contrasting numbers, I think, would be at play when it comes to the entire FMCG sector per se. There was a time when if HUL is doing well, others will also do well. I think it's a very differentiated kind of a quarter now. We've got two quarterly numbers, one from Godrej and one from Marico. Marico numbers don't inspire too much of confidence. Godrej Consumer inspired a lot of confidence. I think Marico has done nothing, if you frankly ask me, in last 1 year. And there's reason to believe that the underperformance will continue. Godrej, I think, is an interesting one, largely because change of guard, volume growth coming back, and palm oil prices have come down for them. That, I think, is the biggest hurrah for a company like Godrej Consumer.
Okay, so there you have it. Godrej Consumer is likely to take the lead as compared to Marico. Ayesha?
Oh yeah, Indian Hotels, Marico, Godrej Consumer, all those stocks on our radar this morning. Let's also track some of the other names which are going to be in focus. And, Biocon definitely is going to be one such case in point. They've completed the integration of Viatris biosimilar business over the other 70 emerging market countries. So that's going to be another stock in focus. This KEC International, they've bagged orders, a sizable one at that, 1,042 odd crore rupees across various businesses. There's Bombay Dyeing, and many reports are indicating that they may be selling their Worli land parcel at a valuation of 5,000 crore rupees. So that's the other stock in focus. And Prestige Estates as well, which is now getting into a joint venture with WS Industries to develop IT parks on about almost 6.5 acres of land in Chennai. So these are a couple of buzzing stocks that we're going to be tracking. Tata Power, of course, I already mentioned that one. And then, of course, there's Ujjivan SFB as well, wherein the Q1 dispersals have come in higher by 22%. And the deposits as well have risen quite handsomely, about 44.5% or so on a year-on-year basis for them. But Sandeep, before we let you go, any mid-cap or small caps on your radar? Anything that you're recommending buying in this market?
Some of the earlier stocks which we were holding continue to do well. So I think just holding on to them. Among the stocks which have been consolidating, I think BATech Webax still looks good to me because that stock's moved up, it's consolidated, but the performance is quite strong. So I would still think that could have a sizable upside over the next 2-3 years.
Right. Okay. BATech Webax continues to be a favorite with Sandeep. Sandeep, good to have you on the show. We'll let you go on that note. But Kunal, let me come to you. Any mid-cap ideas?
So GSFC is the stock which I would suggest as a buy. In fact, many of the fertilizer stocks have started to pick up pace. GSFC managed to cross above 164 mark, minor resistance, a rounding bottom pattern on the daily charts, as well as a bounce and a support from the 50-day moving average. So on the back of it, would suggest a buy, 186 as in the next target for the stock, and stop loss at 160.
Right. Naresh, what about your mid-cap ideas?
So that would be a buy on Tata Power. The stock has gone through a sideways period of last 12 to 18 months and has gone nowhere after that huge rally in 2021. From a peak of 290, the stock corrected all the way to 190. 3 times over the last 12 to 18 months. Made a recovery in March to currently. So it made a breakout move also about 215 levels, which was a resistance for the last 3 to 4 months. Now, over the last 1 month, the stock has been getting into a range. 215 has been acting as a support. Recently also bounced back from it a couple of weeks back. And the upper band for the resistance is 225 to 228. Yesterday also came close to it. This could break out going forward. So a preemptive buy here, keeping a stop loss at 215 and a target price of 250.
Right. Okay, let's tell you what else is happening outside the world of equities. And Musk versus Zuckerberg war is now heating up as Meta-owned Instagram has officially introduced Threads. Now, this is going to be competing with Twitter. Experts say many Twitter users are unhappy with the slew of changes announced by Musk recently, which could attract them to the Threads app. Threads allows users to post up to 500 characters and has many features which are very, very similar to Twitter. Also, US has lashed out against China after it imposed curbs on critical metals used in making semiconductors. In fact, reports are indicating that in retaliation, US is also considering to restrict China's access to cloud computing as an attempt to limit China's ability to develop artificial intelligence capabilities. And back home, Pawar versus Pawar fight heats up in Maharashtra. Deputy Chief Minister Ajit Pawar has asked his uncle and NCP founder Sharad Pawar to retire from active politics and make way for young blood. Remember, Pawar Sr. is now 82 years old. Meanwhile, both the warring factions of NCP have staked claim over party's name and symbol, and the battle has reached the Election Commission as well. And a quick weather check. The IMD has forecast moderate to extreme rainfall in the state of Kerala for the coming few days. Heavy rains are expected in Karnataka as well. And for Mumbai, the orange alert has been issued and heavy rainfall is expected over the next few days. Meanwhile, New Delhi is expected to see some more showers over the next few days as well. Also, over 67,000 devotees visit the Amarnath Cave Shrine in the first 5 days of its opening. As per reports, 3 people have been reported dead during the pilgrimage. Meanwhile, various facilities are being extended to yatris, including langars, health checkups, food and water, etc. The 62-day-long pilgrimage in Jammu and Kashmir's Amarnath will conclude on August 31st. And in sports action, BCCI has announced a 15-member T20 squad for series against West Indies. Youngsters Tilak Verma and Yashasvi Jaiswal have been called up. Virat Kohli and Rohit Sharma get rested. Hardik Pandya will be leading the squad with Suryakumar Yadav as the vice captain.